Let's bring him in. Mr. Craig Bolanos, he's the co-founder and wealth partner at VestGen Wealth Partners up in Chicago. Craig, thanks for being on.
Hey, good morning. I just want to know, Scott, do you think the stock market's right or do you think the bond market's right? I got a stock market that thinks the Fed is going to thread the needle. Everything is going to remain great. I got a bond market who's worried that jobs market is going to start approaching 4.5% possibly by the end of the year. What's on your radar?
That is probably the question of the year. I think it's a great question, and I've been talking about it. I talked about it yesterday on my show. That 10-year yield was underneath. Actually, we did print a 3 in that 10-year yield. It was 3.9%, 3.99% the day before we cut rates, and we cut rates 25 basis points, and all the 10-year yield has done is go straight up to 420. I mean, that's not good if you're looking at the things that affect us, the mortgages, our car loans, and our credit card debt. But it's telling us that the big boy, which is the bond market, is worried about inflation, right? And I think you're exactly right to ask the question. I think that it's a short-term worry. I think that we could have a supply-side boom without inflation. I listened to a few people last night. We don't see the inflation at the ports that you'd expect if with these tariffs. But I think that we're still worried about it. So I think that inflation will be, I'm not going to say benign. It'll be there, but it's going to be closer to 3% than 2%. And I think that the Fed's got a chance to continue with their path a little bit lower. There's a little bit of there's 70% of that is my head and 30% of that is my heart. How about that?
I was going to say it did sound a bit of a mix of emotion and intellectual thought, but in the same vein, you have to look. I mean, the entire move off of the April reactionary lows, this entire move has been nothing more than a move of resounding AI enthusiasm. And yes, things haven't turned out as bad as we all thought they were. I'm paying attention to some little details. I mean, did I just see AI capital expenditure in a recent report amounting to 4.5% of total GDP? Boy, that reminds me of all the spending we did back in the internet day with numbers similar to that. It just took longer to adopt. I certainly don't think it's going to take as long for the AI to have full spread adoption, but that's the gamble. And certainly it's creating a mountain of worries that many people are still biting their nails over. Valuation, I mean, S&P, cap weighted at 23 times earnings, equal weighted indices at 18 times earnings. That's one of the largest disparities I've ever seen in my career. That's a factor of 5. Wow. Look at those spreads. So none of that means people shouldn't be long. I think, as even Tepper said, I think it was 2 weeks ago, hey, I might not enjoy the current cocktail mix, but I have to understand that you don't fight the Fed. And I think that's where everyone should be. Just lean into it, guys. Don't fight the Fed. Don't fight the tape. Stay long. Hold your nose at some of the pieces. It's going to be okay.
Hard to argue with that, and I'll throw into this. PCE came in as expected. Month over month was 0.2, and what do we have year over year came in at 2.9, and that was what it was expected, and that was what was previous as well. We did have an adjustment. The previous month over month went from 0.3 to 0.2, so there was a little bit of a lowering there. So that's going to keep some worries at bay, I think, for the short term here. We'll see. But I was worried that was going to come in hot and that was going to cause a problem.
It would have caused a problem. I mean, there is a tussle between the bond market and the equity market right now. That's why we talked about it in your opening salvo today. And there's not significant data, but there's all these various waypoints for us to check in from what I call the job list claims the other day, what we're seeing here in terms of PCE, and I think we're going to be okay. But, usually September is nasty September. We've completely bucked the trend. Hopefully October will, keep the ghosts and goblins and ghouls under the bed and in the closet, and they won't rear their ugly head.
Well, it's okay. Another thing, I just can hear my old man say it now. Every now and again, it's okay for the market to go down. What the expectations are ridiculous. So, yeah, we've had a few down days, but that's okay. And if you go back, 100 years, it still moves from the lower left to the upper right. So, you just have to be able to, have the wherewithal to stick to your plan. I do love that, and I think I'm going to use that on my show. This tussle between And people need to know that the bond market is bigger than the stock market, correct?
Yeah, I mean, there's the old analogy that the smart money is in the bond market. I mean, it's not always right in the short term, but it's typically proven correct in the long term. And you got to pay homage to that fight that's beneath the surface that many retail investors do not get an opportunity to see because we're so focused on the sensationalism of what the S&P is trading at, where is the Dow or the NASDAQ on any day. But I don't see a lot of headlines and a lot of programs outside of yours talking about treasury yield spreads and other things. So I think we would do well to continue to pay homage and enlighten that small category that's trending beneath the surface. I call it a current.
Yeah, there's a couple, Art Laffer from the Laffer Curve, his son comes on my show, Art Laffer Jr., and his partner, Nancy Tengler. You may have seen her on CNBC and Fox and the likes. But I would say pretty much you've done it a little bit. But you and those two are pretty much the only folks that have been really telling us don't forget about this inflation problem because it could be an issue with the bond market. And so they've been right all along. Well, everybody, you know how it is. Everybody wants stocks to go higher, so they don't want to talk about it, right? They want to talk about rate cuts and watch everything grow. But if you're responsible, you have to, and that's what I think you mean by paying homage. I totally agree, and we'll do that. We're going to absolutely do that, and I appreciate your blunt honesty, and it's a great question, and I might actually do that on my show today. But, Craig, thanks for getting us started here on a Friday. It's Craig Bolanos. He's with VestGen Wealth Partners. He's a co-founder and wealth partner up there in Chicago. Remember, you can call us today. It's a call-in show, 855-776-6147, 855-776-6147, or text if you're a little shy. But we'll get to more of those calls and texts right after this break. We'll be right back.